Hannah Gooch-Peters, Sandam Investments, global equity investment analyst, is joining us now. The mood music, certainly from European CEOs, is turning more and more positive. The catch-up trade between Europe and the United States certainly looks like it's starting to pick up a little bit. European equities have tracked reasonably strongly against their US counterparts over the last few months. But there is still this sense that Europe can outperform over the next few months. Hannah, can you give us a sense of kind of how big that catch-up trade potential is right now?
Good afternoon. I think that catch-up trade potential could be quite large. So if you look at valuations, say, in comparison of the US versus Europe, you'll have seen that the US, particularly if you're looking over a long time period, will have substantially outperformed Europe. Now, I think we've got to be careful when we're talking about European equities versus, say, US equities, for example, because you have to remember these big multinational companies have revenue streams coming from all over the world. So if you're looking for potential for catch up in Europe, I think we're very, very focused on COVID cases and vaccination rates and so forth. And Europe is quite far behind the US. Just for example, on that front, we've had problems with deliveries, we've had problems with confidence in like the AstraZeneca vaccine, for example. And so with the improvement in the European economy, confidence from investors, consumers and so forth, I think you will see an uptick there. But the question is, how much of that has already been priced in? And you saw a substantial move in Europe, especially from the end of October, start of November, when that vaccine news started to come out. But it's all to play for. We're going to have to see what happens with companies when they report.
So to that point, the underperformer has been the Spanish equity market, but that is really exposed to travel and vacations. So how do you square the catch-up potential there with the fundamentals of, like, we literally don't know when they're going to be able to really have that holiday season?
I think what we could look at here is a company like Amadeus, for example. That is a Spanish-listed airline software company. Now, these companies are really based on how many passengers are booking their flights. And so we're going to need an actual uptick on people actually getting on planes, booking hotels and so forth before we start to see a meaningful recovery in stocks like that. But also, I keep reiterating my point that these companies do have international revenue streams. And so you're going to have to see a more broad-based recovery before we start to see an uptick there.
Hannah, what I'm hearing you saying is you want to buy the big multinationals out of Europe, but you want to avoid the domestic plays thus far.
I think that's true in a way. There's different kinds of recovery going on in different parts of the world. At the minute, Europe, I think, is lagging a bit on vaccination rates versus the US. They've got over half their population done in the US. The economy there is, I think, showing more significant signs of recovery, but that doesn't mean these businesses are any less great to invest in. If you could take, for example, a company like Bookings Holdings, it's listed in the US, but it has really extensive European exposure through hotels and so forth. That company has done dramatically well over the last, say, 6 months on the recovery of the vaccine news and improvements in travel and so forth.
So does that mean that you want the US company with the exposure to Europe rather than the European company with exposure to China, for example?
I think we want both. If you're looking at a company like Heineken, they have exposure all over the world, but their results were very good. But their European exposure, their European part was their weakest part of their results. Their Asian part was one of the strongest. And so I think it's good to have diversity in a portfolio. And you can pick up all the different kinds of trends and so forth and recoveries in different parts of the world.
Where do you stand on commodities, Hannah? London's got plenty of mining companies. If you're looking for that trade, it looks like a better position to be in than, for instance, over in the United States, where commodities tend to focus around the energy story. Do you see a super cycle? Copper goes ever higher. How do I play it? Do I go for the miners? Do I go for the services companies? I'm wondering how you could take advantage of that trade.
So personally here, we don't invest in commodity companies within our portfolio, but over the last few months, they have done incredibly well. I mean, the energy sector, for example, which you highlighted there, has had a substantial move on the back of the vaccine news, the thoughts of the economy reopening, manufacturing and so forth. And so that part of the market has been very, very strong. But the question is, has that already been priced in? And quite possibly, I think it's potentially priced in a recovery that hasn't yet happened yet. So I think that the importance here is actually having diversity within your portfolio. there are lots of other sectors too, and ways to play that kind of recovery without necessarily having direct exposure there. You can look at other parts of the market that have also lagged. For example, if you're looking in healthcare themes, you've got your companies that have their kinds of procedures which have been delayed, like knee replacements and so forth, that will start picking up again as the pandemic subsides. And you've got also companies that have not been affected so much by the pandemic. You've looked at things like Google's results that have had very strong on the sides of digital advertising and so forth. So I don't think there's a specific need to pay a very, very tiny part of what is I think it's only 3% of the world market. You could have a diversified portfolio and partake in it in all sorts of types of recovery.
Oh, and not include commodities, it's like a knife in my heart. No, I'm kidding. Then if we go towards the margin question, because in the US, it's all we're kind of talking about. If you were to hedge against some kind of inflation risk, whether or not you believe it's real, how do you do that?
So I think a really good example here would be a company like, I'd say Nestle. We want companies with really good pricing power, high barriers to entry. And so if you looked at their results last week, and I know it's not a US company, but they do have this revenue all over the world, and because they have this pricing power, able to put through those input cost inflation through to their consumers without compromising on the volume growth. And that is because they have this strong pricing power. They're benefiting from trends such as people having coffee at home instead of coffee outside, people buying pets during lockdown, so they're able to put up the prices of their science-based pet foods, for example. So that is the way that I would look to mitigate that risk of inflation, is by having companies that are able to post organic growth rates faster than that rate of inflation.